Well, good evening, everybody. I'm going to go ahead and get started. My name is Lori Fredrickson, and welcome to the June meeting of the Bivio Club meeting. We are very excited today to have Paul Madison, who's going to talk about covered options. Paul is a very popular presenter with many individual investors. He has a Bachelor of Science in Chemical Engineering, and he retired after working for Conoco, including several years as a crude oil commodity trader. He's been an investor in individual stocks for over 30 years. He trades options on a daily basis, and he's currently a member of a family investment club with members ranging in age from 19 to 92. The club uses conservative options strategies to supplement their portfolio returns. So Paul is practicing what he preaches, and we're really excited to have him here to talk about it tonight. I'm going to go ahead now and turn this over to Paul.
Thank you, Lori. Good evening to all. Glad you could come tonight. I look forward to a fun evening together. Online is always tough, so I like interactivity. Feel free to type questions to Lori. It is a long presentation, so we'll probably just ask her to accumulate them, and at breaks we'll answer the questions, and maybe we'll have time at the end for a little bit of one-on-one. To encourage you to stay listening to the bitter end, I will tell you we have a little bit of a surprise that we're going to talk about at the very end, so stick around. So tonight's topic is covered options, a tool, what I call a tool for the fundamental investor. And this is a joke that Saul Seinberg sent to me that I think sums it up, that really we're going to make all the money in the options. Just a quick reminder, I am just a volunteer presenter. I'm not going to be soliciting you to buy or sell anything tonight. This is just free investment education, and as always we encourage you to, before investing in anything, consult a professional or be sure to do your own research as well. One other kind of little disclaimer, tonight's topic is a little more advanced. It will probably be best if you already have some basic knowledge of stock options. That doesn't necessarily mean you've traded them, but maybe you've attended other classes on stock options, because I'm not going to necessarily go all the way down in the weeds on what a stock option is and how to do them, but I will cover some basics. And more importantly, we assume that you already have a good working understanding of fundamental investing. So what are we going to talk about tonight? Well, as I said, I'm going to do a quick refresher on what covered options are, kind of the basics, not quite in the weeds, but a quick overview. And then I'm going to spend some time on some of my own ideas that I've developed over the last couple of years, some tips, tricks. We'll look at a few real trades and some ideas on what stocks work best for options. One of the analogies I like about covered options is a baseball analogy, and in baseball terms, selling covered options it's really a great career of singles. You're not going to hit home runs, but you're going to hit lots and lots of singles. If you accumulate those, it may end up being well worth your time. I wanted to cover one quick little lingo that I'll be using. I'll talk about buy and sell side options, and what do I mean by that? So first, buy side options. What this means is this is an option that is initiated by first buying the option. It's also known as going long options, and when at a brokerage house you'll see it as a buy to open or a BTO. All of those are referring to an option that is a buy side option. You can tell by my red and then my unhappy faces, I don't necessarily really recommend this. What tonight's is about is sell-side options. These are options that are initiated by first selling an option. This is also known as shorting options. And the first trade will be known as a sell to open, or sometimes abbreviated STO. And we'll get lots of smiley faces for that. And as I said, tonight's session I'm going to be talking about what I believe is the more profitable options, which is the sell side. Lori gave you a little bit of my background. I'm going to cover it again just for a specific reason. I have been investing for a little over 30 years. I did spend a little bit of time as a commodity oil trader while with Conoco, and I bring that up just because I did get some option experience around commodities, and in fact at that time I really tried to apply them to stocks, and so I tried buy-side options 20 years ago. And to begin with, I had some good trades and I made some money and I was pretty proud of myself, and then fairly quickly I lost all of that money and maybe some more, and I said I'm going to go back to my knitting and just stick with stocks, something I know and can do well. I always thought of myself as an active learner, so I don't know why 20 years ago it didn't dawn on me that if buying options was a losing proposition, it should have clicked that selling options is possibly a profitable game. No, I had to wait some 20 years, or almost 20 years later, to taking a couple of Marianne Davis's classes at InvestEd on covered options. She does a wonderful class on covered calls and another class on cash secured puts for me to see the light. And ever since those classes, I've been very, very active with sell-side options. So why do sell-side options work? Well, there's a couple analogies that I like to talk about, and I think actually Marianne talks about both of these. And I like to tie one to covered calls and one to cash secured puts, and we're going to look at each of these. So the first is the least to buy, and this is covered calls. So on a covered call, you have an asset, your stock. You want to sell it at a specific price, and that price is above the current market. Someone else out there may want to buy your asset. In particular, they may be interested in buying it if it takes off and goes up a lot more from where it is today. So they essentially lease your asset for a short period of time. In an option lingo, this lease is called a premium. They pay you money for the ability to have the right to buy your stock at the agreed price. And normally this agreed price is above the current market. If they don't buy, then you are free to lease again the next month. I think this is a wonderful way to look at covered calls and makes us feel better about what it is and how they work. As a contrast, the analogy that works for me for cash secured puts is insurance. So you have cash. You're interested in possibly buying a stock, but it's at a price above where you'd like to buy it. You'd like to buy it a little lower than the current market. And there are people that are interested in wanting to ensure that they can sell that stock in case it starts falling, and they want to be able to sell it at a certain price to get out. So they're going to pay you a premium to make sure that you, as the seller of the option, will buy their stock, and you are agreeing that you'll buy it at a price that's lower than the current market price. Why does insurance work? Well, it works because of fear, and the same is true for options. The only reason people are willing to pay premiums for puts is because they're afraid the market might, or their stock might fall, and they want to be able to get out at a price higher than where it falls to. And who makes money with insurance? Well, of course, we all know, since we all buy insurance and we know how much we spend on it, we know who really makes money on it. It's the seller of insurance. And that's what you, as a seller of cash secured puts, are, is you're providing the role of the insurance company. There's another piece on why selling options wins, and that's because options are a wasting asset. They have what is called a time premium in their value, and that time premium decays to zero at the expiration date. And so that time premium decaying means that it's a wasting asset. And we all know it's much better to sell a wasting asset than to buy it. And why do we know that? Well, lots of us have bought a wasting asset because for the most part, cars are wasting assets. Very seldom do we buy a car and it goes up in value. We buy cars and they tend to depreciate fairly quickly, and that's another wasting asset. As kind of a side thought around buy-side options, as I say, I like to call a good way to lose money. The people trying to get you to buy options might just be the people who are selling options. And I say, forget that, come over to the sell side and enjoy the profits. A little bit of overview now, the big picture. I still fundamentally believe that most of the money we're going to make in our portfolios is done through fundamental investing, buying our traditional good quality growth companies and watching them go up year after year. Using our GARP, growth at reasonable price principles, that's where we're going to make the real money. But selling options is something that can be done to supplement your returns. It does require a little more attention than our traditional long-term fundamental investing, but it still should be done on the same stocks that we're looking at with our fundamental investing, good quality growth companies, and that's important. So let's go through a refresher on option basics. On options, one thing that people that are new to it have to get used to is that one option contract represents 100 shares of stocks, and you have to have or be dealing with 100 shares of stock to be able to sell a contract. Every option has a strike price. On the calls, that strike price is the price that you as the option seller might have to sell your stock at. On the puts, the strike price is the price that you as the option seller might have to buy the stock at. Options have strike prices, and typically these are in increments of $5 on most stocks. There are some stocks where it's $2.50, and there are even some others, particularly the index ETFs, where it's every dollar. And every option has an expiration date. And let's look at kind of some of the common option expiration dates. First, and the one that you'll see on most stocks, are monthly options. These are every month. They expire on the Saturday after the third Friday of each month, and because the market's not open on that day, effectively they expire on the third Friday. Many stocks only have options for just a few months out. So we're sitting here at the end of June. Most stocks might only have July and August options available. There are some companies that are heavily traded and go several months out or even further. A lot of the big companies or companies that are heavily traded and the index ETFs have started trading weekly options, and actually the list of companies that are trading weekly seems like it goes up almost every week. Weekly options become available, start trading the preceding Thursday. So as an example, the weekly options that will expire next week on July 6th, they will begin trading tomorrow. So they'll trade for normally 7 trading days, 2 in the first week and 5 in the week that they expire. It can be fewer than that if there are holidays, as there are next week on the 4th of July. They always expire on the last trading day of the week, which is normally Friday, but if Friday is a holiday, then they'll expire on the Thursday. And then another common expiration are quarterlies. These are primarily the index ETFs, and quarterlies expire on the last trading day of the quarter. So second quarter options are available right now on ETFs, and they will expire this Friday, the 29th, which is the last trading day of the second quarter. We have 2 types of covered options. We have covered calls, as we said before, and these are used for when a stock's price is getting close to your sell level. And we have covered puts, or they're actually more often called cash secured puts, and these are used for when a stock's price is close to your buy level. And I'd just remind you that your buy and sell levels are the ones that you've done, come up with through your fundamental analysis, your traditional long-term investing analysis. Let's see, a quick stop here, Lori. Do we have questions?
Yeah, there was one question. Do you know whether all brokers require cash to be in the account when you sell a cash secured put? I guess the question is because they have the use of your money during that time and they really don't pay you any interest for that.
If it is a cash secured put, which is a covered put, yes, the cash will have to be in the account. You can sell naked puts or calls where the cash doesn't have to be there, and then that has to be done in a margin account, and you would not have to have the cash there. But for a true conservative cash secured put, you would have to have the cash in the account.
But if you did it in a margin account, you'd actually be paying interest on that margin while you were borrowing.
That's correct.
Okay, that's the only question I see so far.
Okay, very good. So now we're going to go into each of these in a little more detail. First, covered calls. So why do I want to sell a covered call? Well, your stock is up nicely, but it isn't quite to where you want to sell it. It's still slightly shy of where you'd like to be able to sell it. But, and this is the important part, you think the stock might be exhibiting something that says it may go down next. And so selling a covered call is best, the premiums are the best when the stock has moved up for a while, the stock is up on that day, the market is up on that day, and volatility, which we're going to talk a little bit more about later, is also up. But if you do technical analysis, you're starting to see some reversal or bearish indicators that says maybe the next move on the stock is back down. This is a great time to be selling a covered call as a way to generate some income against your asset, your stock. When don't you want to sell a covered call but just sell the stock? Well, there's a couple situations where I say you don't want to be selling a call, you just want to make that sale, and that's when you can see that the stock is clearly overvalued. The market has gotten ahead of itself, PEs are too high. Don't mess with selling a call, just go ahead and sell the stock. Or the other place that it's important to just sell is if there's been a significant negative change in the fundamentals. So the company has announced something material to their forecasts that's going to change your impression on the value of that stock. Just go ahead and sell. Don't try and do it with covered calls. So how do we sell a covered call? Well, you must own at least 100 shares of a company. You determine your sell level, and your sell level is the minimum strike level. So if your sell level is 98, you might have to go up to 100 to get to the first strike that would be above your sell. To begin with, I think it's probably best to start with selling front months. That's the first month that's available. So as we're sitting here in June, the front month would be July, and July options will expire on July 21st, which is this Saturday after the third Friday. So right now, if you were selling a covered call, it would be July, would be the front month. And then you sell one contract for each 100 shares that you're trying to cover. After you have sold it, one of three things will happen. The option will expire worthless, or the option might be bought back to close it, or the option is exercised. And let's look at each one of these in detail. So first, the option expires worthless. So if you keep the option open until the expiration date, and the underlying stock closes below the strike, so the one we were just talking about, if we'd sold a $100 call, the stock closes at 95, then you not only retain your stock, but you get to keep all the premium that you collected. And if it's in a taxable account, that premium is viewed as a short-term capital gain. Second thing that might happen is that sometime prior to the expiration date, you as the option seller decide to buy the option back to close it. So this is a buy to close trade. You get to keep the difference between the premium you originally sold and the premium you paid to buy it back. Normally that's positive, but you may in fact sometimes buy back and have a loss, but I wouldn't recommend that. Once you have bought the option back to close it, it is closed from your perspective and you are released from your obligation to sell the stock. In a taxable account, any gains or losses that you have would be viewed as short-term capital gains or losses. And then the last thing that's possible is the call option gets exercised. So if the option is left open until the expiration date, the underlying stock closes above the strike, you get to keep all the premium you collected, but your stock is sold at the strike price of the option. So in our example, if we'd sold a $100 call, we would sell our stock at $100, and if the premium we collected, as an example, was $2 per share, then our sales basis is going to be the strike price plus the premium, net of commissions, of course. So if our strike was 100 and we picked up a $2 premium, our sales basis is 102 less commissions. Any questions on the calls?
Yeah, there's a couple questions. You had a chart that had a $5 increment. Were you talking about strike prices?
Yes.
Okay, so the $5 increment is just $5 differences between the strike prices that are available.
That's correct. Options that are available often are spread by $5 increments. So on my example before, and whatever stock it was, it might be a $100 call and a $95 call, a $105 call, but you don't have in between dollar levels on most stocks.
And then somebody asked if your option expiring without being exercised, isn't that considered, they're asking if that would be considered a return of capital that would just lower your basis on the underlying stock.
No, it is not. It is viewed as a short-term capital gain. It is a trading gain, and it is not tied to your stock. Return of capital is something that has to be done by the company, and options are not, you're not involved with the company at all. You're doing it as a trading tool against your asset.
Jim Thomas is asking about what about early exercise for stocks that pay dividends?
That's a great question, Jim. The most exercises only happen on an expiration date. The one exception that Jim is asking about is there are some times where the buyer of the option may elect to exercise early so that he can own the stock and be the owner of record. So that means he has to exercise 3 business days before the owner of record to be able to capture the dividend for that stock. And that is the one time that you might be exercised before the expiration date. Great question.
Okay, and here's a question. If I've owned the stock for over a year, is the sale price profit long-term gain and the option money short-term gain?
We're going to talk about that a little later, so let's hold on to that question.
Okay. And when you say the stock closes above the strike price, does that mean a close of the day price or the price at the expiration date?
the close price on the expiration date. So at the end of the trade on the third Friday for monthlies.
And somebody's asking if the tax rate is the same on an option capital gain as on a stock sale capital gain.
No, gains on options, and let's not talk about exercise for a second, but just on the premiums, if they expire worthless or if you buy them back, those are short-term capital gains. Short-term capital gains are taxed at your normal incremental income tax rate.
But that would be the same as a short-term gain if you had a stock.
Yes, I'm sorry. Yes, correct.
Okay.
The only time an option will turn into a long-term gain is when you are in fact exercised, and as I said, we'll talk about that a little later.
Okay, great questions, but that's all for now.
Okay, so let's kind of quickly run through cash secured puts. So why sell a cash secured put? Well, the stock is down and you're interested in buying it, but it still isn't quite to the range that you want to buy it. But you also are thinking that the stock is about ready to go up, and so you're wanting to capture something out of the opportunity even though you're not quite ready to buy. So when do you want to sell a cash secured put? Well, the premiums are best when the stock has moved down for a little while, and on the day that you're selling the put, the stock is down and the market is down on the day. And volatility is up, and as I said, we're going to talk a little more about volatility. And if you do technical analysis, you're looking for reversals, bullish reversal indicators, things that are saying the stock is about ready to go up. So it hasn't quite passed through the range that you want to buy it, but it's about ready to go up. So we're going to sell a cash secured put. But when don't you want to sell that put? And it's similar to the selling. If a stock is way undervalued, you don't want to mess with a cash secured put. You just want to buy the stock. And the same thing as the call, but the opposite. If a company has announced some positive change in the fundamentals, then you don't want to mess with selling a put and missing the chance to buy the stock. You want to go ahead and just buy the stock. There's one other thing on puts I would caution you is I don't think it's a good idea to sell puts that expire right around or right after an earnings release date. This is kind of the equivalent to an insurance company selling hurricane insurance after they know the hurricane is coming. And as we all know, insurance companies don't do that. Once a hurricane's kind of been pinned down and we know where it's going, insurance companies close the gate and they don't sell policies that cover that incident. Same thing on selling puts. I really don't recommend selling puts that go over an earnings release, because as we have seen several times recently, negative surprises can mean significant drops in the stocks, and you could be caught buying the stock at a much higher level than where it falls to after the earnings release. Not a good plan. So selling a cash secured put, first determine your buy level that you want. This sets your maximum strike price. So opposite to the one we were just talking about, if your buy level was 102, that's your maximum level, so you might have to drop down to 100 put. You have to decide how much cash you have available, and this sets how many shares, and again this is in 100 lots of 100 shares. And again, I would recommend selling the front month expiration. So for right now, that would be July. And you're going to sell one contract for each 100 shares. After you're sold, same thing, one of three things will happen. Option expires worthless, option is bought back to close it, or the option is exercised. The first two are just like the call. If the option expires worthless, you get to keep all of the premium. If you buy it back, then you get to keep the difference between what you originally sold it for and what you bought it back for. Both of those are viewed as short-term capital gains. The option is exercised. Let's walk through that one. So if the option is open until the expiration date, the underlying stock closes below the strike. So in our example, we sold a $100 put. If the stock closes at 98, then you get to keep all the premium, and you have bought the stock at the strike price, and your purchase basis equals the strike less the premium. And at this point, your option gain, your premium, is rolled into the basis for your stock, and the determination on whether it's long-term or short-term will be a function of how long you hold that stock. If you hold it for a year, then it'll be a long-term gain. I guess I missed that on the call. On the call, when it gets exercised, the sales basis represents the strike price plus the premium, and whether it's long-term or short-term is a function of how long you had held the underlying stock. If it's more than a year, then again that will be a long-term gain. Less than a year, short-term gain. Normal rules of holding stocks. So just kind of a reminder, if a stock's a screaming buy, don't sell puts, buy the stock. Same if it's a screaming sell, don't mess around with options, sell the stock. Covered options work best when you're talking about prices that are close to a reasonable buy or close to a reasonable sell. Take another quick break.
Just one question. Somebody wants clarification about an option stays open until the end of the market on the third Friday of the month that you pick?
It stays open to that point unless you buy it back. You always have the option to buy the option back, and when you buy it back, that closes your position. So you sold to open, and then you buy it back by doing a buy to close, and that completes the option transaction, and you're back to owning stock, and you have whatever gains or losses that you have on the option trade.
Also, it's only monthly options that expire on the third Friday. Weekly ones expire every Friday, right?
That's correct. Monthlies are on the third Friday of the month. Weeklies are every Friday. You won't get a new weekly in the same week that the monthly expires. The monthly just covers that week. And you won't get a new weekly if the quarter happens to end at the end of a week, as it does this week. So there weren't new weeklies for this week because the quarter ended on the last day of the week.
Okay. Chuck is asking, will a stock always be put to you if it's at your strike price? I assume at expiration.
If you have not bought the option back to close it, and it is if it's a call and it's above the strike, your stock will be called away. If it's a put and it's below the strike, it will get put to you. And literally that can be pennies. Now, what I would recommend to you is if you get to that last day and it's very close to the strike and you don't want to be exercised, you can buy the option back on that day, and the price you will pay will be roughly the difference between the strike and the market. So if the strike is 100 and it's trading at $99.95, you should be able to buy that option back for something less than 10 cents. So often you can buy them back, and you'll be buying them back for less than what you sold them for, and then you won't be exercised. So the buy to close can be any point right up to closing bell on the expiration date.
But if you're holding a put, or if you sold a put and the stock gets to the strike price before expiration date, it won't be put to you on that day, right?
No, that is correct. For the most part, exercises only happen on the expiration date, with the one exception that Jim asked about earlier. Sometimes on calls you can be called away early if the buyer of the option decides they want to own the stock to be able to capture the dividend. Other than that, it's not in the it's not to the buyer's advantage to exercise early, because there's still time premium in the option. So rather than buy the stock, they can actually make more money by just selling the underlying option to close their position. So they have no reason to exercise early. So the exercises only happen on the expiration date.
Dan House is asking, when you're selling a call, do you have minimum required returns for the transaction, etc., which I think is what you're going to be getting into. So Dan, if you could wait a little bit, maybe we can answer your question. Paul will answer it as he's going along.
Yep, that's exactly where we're going to, or will be getting to here fairly quickly.
And Nancy Bethia is asking, if you decide to buy back an option, what determines how much you pay, and you're going to get into that too.
Indeed.
I think here. So if you two can wait, and then if you still have questions, bring them up again after, I think, the next section. That sounds good.
Okay, very good. So next thing I wanted to talk a little bit about is volatility. And why do I want to talk about volatility? Well, volatility is equivalent in the stock market to what drives insurance. Fear is what drives insurance. So which would you fear more, driving around town or driving a race car? Well, most of us would be driving the race car. And because of that, if we wanted to insure that activity, we would expect to have to pay a higher premium with their insurance company to be able to drive that race car than drive around town. It might be questionable, but depending on what your town is that you're driving around. But for most people, it's the race car example. Well, fear in stock terms is volatility. And what do investors fear? Well, there's kind of two things. One, they fear a huge price drop on their stock. And the other thing, and this is, I say fear, maybe greed's a better word, but they worry that they're going to miss out on an opportunity to be involved with a stock that takes off extremely quickly. So those are the two things that drive stock market volatility. And the volatility is what drives option premiums. Many of you probably realize that there is an index that measures the broad market volatility, and this is the volatility across the S&P 500 options. It's called the VIX. And this is just a chart through, I guess, about the end of 2011, so about a little over 10 years. And you can see that the VIX, for the most part, trades kind of roughly mid-teens to probably mid-20s is kind of where it spends most of the time, with excursions above that and some periods below that. But most of the time it's 15 to low 20s. And then the question would be, well, which of these stocks would you fear the most? And I think most of us would say, well, maybe Apple and Google. And again, it's a combination of fear and greed. Sometimes we worry that we aren't in Apple or Google because we think it might take off. But clearly Apple and Google have more volatility than some of these other stocks, Medtronic, Colgate, or IBM. So how does this come into play on the options? Let's look at it. So this is some random data. It's from February 4th of 2011. And just as kind of a reference point, the VIX was at 16 on that date. And we're going to look at some first out-of-the-money calls with March 19th expiration. So that's 43 days after February 4th. And first we'll look at IBM. And we know from our long-term investing, our fundamental investing, that we have a long-term measure of volatility called beta. And if the stock market has a beta of 1, then companies that are less than 1 are less volatile than the market. and companies over 1 are more volatile than the market. So IBM is less volatile than the broad market. On this particular day, the stock price was $164. Our first out of the money call is $165. And the option premium on this day for that call was $2.61, 1.6% of the stock price. So that's just 261 divided by the 164. So for comparison, we can look at a stock that's a little more volatile, Google. We can see that even in its long-term volatility indicator, the beta is 1.2, so it's more volatile than the stock market. On this particular day, the stock price was just under $611. The first out of the money call would have been $615. And so the option premium would have sold for $15.30. And you can see that that's 2.5% of the stock price. So the more volatile stock does in fact command much higher premiums as a percent of the stock price. I like to look at these premiums, the percents that we were just talking about, as kind of interest earned on the asset. So let's go through an example again. So spiders, this is again back in the beginning of 2011 at 102. If we sold the first month output at $100 strike, so we're selling puts, so we have to be covered with cash, and we collect a $1.50 premium, then the percent earned is the premium divided by the underlying asset, or 1.5 divided by 100, or 1.5%. And then the other thing I like to do so that I can compare across stocks and across expiration periods, cross strikes, is to translate that into an APR. So if we know that the option, in this particular case, I said it had 28 days left, then to get it to an APR, so an annualized percent return, I'm going to take my percent earned times 365, so full number of days in a year, and we're going to divide that by the days left on the option. So 365 divided by 28. So in this case, that 1.5% turns into roughly a 20% APR. Just so you can see how that works on the two stocks we just talked about. So the IBM from the earlier example, our option premium was $261. Our underlying price was $164. We already said our interest earned was 1.6%. And our APR, because there were 43 days left, becomes just a little under 14%. And for comparison, our Google 1530 premium, we knew the interest earned was 2.5%, and so our APR is almost 50% more, so 21% versus the 14 on the IBM. So let's move into making it happen. Options are more trading than investing, and when you move into the trading realm, I think it's extremely good to develop a trading plan. And what does that mean? It says that you need to set yourself some rules and targets for how you're going to go about doing covered options. For instance, you're going to be thinking about how far out of the money you want to be on your options. The time frame, so this is where I'm recommending front months, but later you may want to move to either shorter time frames or longer time frames. The types of stocks that you want to be doing the options on, the size of the trades, and the thresholds for buying back. Those are just some of the things you could develop rules on, and as an example, I'm going to share with you just kind of a few of my targets or rules. So when I sell options, I like to look for premiums that give me at least a 20% or greater APR. I tend to do no later than front month And lately I've been doing more and more weeklies, but I think front month's a good place to start when you're beginning. And then I like to watch the premiums, keep track of them, and if the current premium drops to where the APR on the premium is less than a 10%, I like to go ahead and buy it back. I just feel like the risk of leaving the option on needs to give me a reward of greater than 10% APR. And so what does that look like? Well, let's look at an anatomy of an actual trade. So this is a target put, 52.50 put. Target was 53 and change when I sold this. I sold it on February 2nd for 86 cents. That's 1.64% of the underlying. There were 17 days to expiration. That gives you a 35% APR. And we talked about options being a decaying asset. So if everything stayed exactly the same, then that decay line would be a nice constant line, and every day it would decay by the same amount until February 19th when it would reach 0. And so that's kind of what the decay line would look like. Well, I can also draw a decay line for what a 10% APR looks like, and it's down here. And by doing that, we can see that on February 8th, I noticed that the premium had gotten to a lower than 10% APR. So I bought it back for 14 cents, which is an 8% APR. So the extent of the whole trade was that I kept it open 6 days. The premium I collected was a net 1.37% of underlying, and because it was so many fewer days, the APR actually jumps up quite a bit, and it was 79% APR, and that is net commissions. You may say, well, why buy it back here? Why not just let it ride out and expire worthless? Well, that's a long period of time, and I'd rather have my cash freed up, because this was a put. So by buying it back, my cash is freed up, and I now could sell another option at a higher premium for that last 11 days. Plus, things can happen. And in this case, if I had left it open to the 19th, I would have actually been put target, because target closed at 51.90, 60 cents in the money. So it would have been a pretty radically different situation. So when it gets down to being less than a 10% APR, I feel it's worth taking it off and doing something else with the asset, especially if it's cash. Obviously, if it's stock, you may or may not be able to sell a call again in those 11 days, but I still feel like it's worth taking off. Here's another example. So in this case, I sold an Apple $340 call on January 24th for $6.30. The blue line shows you the value of that option all the way till expiration. And you can see it did nothing but trade up, and on February 19th, that option closed at $10. What does that mean? Well, that means Apple stock was at $350. I let this be exercised, and my question at the bottom is, did I make money on this trade? Here are the details. So on January 24th, Apple was at $333. I sold the 340 call, February expiration, February 19th expiration. The premium collected was $630, which is 1.9% of asset. I met my rule of saying I needed a 20% APR. Got called away on February 19th, so I collected the 340, which is the strike, plus $6.30. And so this is my sales basis for my stock, $346.30. And the answer, yes, I made money on the trade because my purchase price was below $346.30. In this case, it was significantly below. So yes, I made money. And I was happy to be called away. Could I have made more? Yes, but every time we sell a stock, we run that risk that the stock could continue to go up. So it's no different than any other stock sale that we make. One other real quick thing I want to run through is commissions, and commissions can spoil your gains. Normal commissions on options are in the $7 to $9 range, and you also pay typically 75 cents for each contract in a trade. Some brokers are less than that, but this is typical. And so if you sold one contract, 100 shares, and the premium is 50 cents, you're going to collect $50, but you're going to end up paying about $10 in commission and net just $40. So that means your $10 in commissions on the $50, and that $50 is the most you can ever make on this trade. On a covered option, the minute you sell it, that's the most you can make. And so that $10 on the $50 collected is equivalent to a 20% commission. So I like to say, kind of as a commission strategy, you should always be looking to collect at least $100 on a trade. You do that by making sure you at least get a dollar premium on if you're going to only do one contract, or if you're doing two contracts, a 50-cent premium. And to minimize it even more, look to maximize the number of contracts per trade. Now that's not when you're beginning, I do think it's smart to start with one or two contracts. But as you get more experience, you want to maximize the number of contracts and or look for stock options with higher premiums. Try to target getting your commissions down into less than 2 to 5% of the trade, and that means your trade is something on the order of $500 to $200. To give you a little bit of my metrics, kind of what I've done, and there's two numbers here. So after about a year, the left-hand number, I was the average of the options I'd sold were 28 days to expiration. As I had mentioned, I've been selling shorter terms, so now the average of all my options over the last 2 years is like 23 days. For the first year, I averaged only holding them for 16 days. That's dropped and is now just under 14 days. My average APRs when sold were 28%. That's held pretty steady, maybe gone up just slightly. And my actual APR achieved by buying them back early was about 40, and it's gone up to about 44. So that just kind of gives you some numbers to compare with when you get started. So when you get ready to sell calls on your stocks, it's best to look for high volatility stocks. Beta is greater than 1. They're going to give you better premiums. You must have at least 100 shares to sell a call, one contract. And it's easier to do on stocks that are broadly traded. And be sure your strike price meets your sell criteria. And you might say, well, what stocks? Well, just for funsies, I picked up the top 10 holdings in Bivio clubs. That's listed here. And 7 of those 10 are stocks that are broadly traded and, in fact, have monthly and weekly options. So a lot of the clubs out there have stocks in their portfolios that could have options traded against them. When it comes to secured puts, cash secured puts, I really recommend for beginners and maybe even advanced, a great place to do puts is in broad market ETFs. And my two favorites are the Spiders SPYs, which is the S&P 500, or IWM, which is the Russell 2000. Why the broad market ETFs? Well, they're a little lower risk than individual stocks. As we talked about earlier, stocks can see significant drops. They definitely can around an earnings release, but there are other news stories that can also cause very significant drops in stock price. And or you can see a 10 or 15 or 20% drop on a stock. Normally, you aren't going to see that big of a drop on a broad market index. There are also a plethora of strikes and expirations on your broad market ETFs. They do weeklies, they do monthlies, they do quarterlies, and the strikes are literally every dollar. Tons of trading volume. And if you're exercised on a broad market put, you can turn around and immediately start selling covered calls against that same position to eventually turn it back to cash. Selling cash secured puts is a great way to generate some income on your portfolio cash. So if you've got cash and you're tired of no interest rate on the money markets and you want to make a little money, cash secured puts is a good way to do it. Speaking of beginning, I do encourage you to start slow, do trades that are 1 or 2 contracts. I recommend the front month expiration. Broad market index is a good place to start, and you may want to try paper trading before you actually start trading options. And then this last warning at the bottom, be leery of the sirens out there, and for selling covered options, these are volatile stocks that have really high premiums. They seem attractive, but there's a reason that the volatility is high, and you need to be leery of that and stick to our more traditional high quality growth stocks. Options and taxes, real quickly. Options that are expired, worthless, or closed by buying back, as we said, are short-term capital gains. The gain is the premium collected minus the buyback price with the buyback is 0 in the case of expired worthless. And on exercised options, the premium is rolled into the underlying transaction. So on calls, the premium is added to the sale price, to the strike price, and on puts, the purchase price is the strike less the premium. And then capital gains is determined by how long the underlying security either was held in the case of calls where your stock is called away, or is held when you have stock put to you. It's when you eventually sell it that will determine whether it's a short or a long-term gain. IRAs and options. The IRS only allows selling covered options in IRAs, and I think this is an indication that they view the risk as fairly low on selling options. I like to say that I think the risk on selling covered options is no different than the risk we already have by buying and selling stocks. So I think it's the same risk. I think it also could be said that this means that they believe buying options is too high a risk to allow it to happen in IRAs. So IRAs are a great place to sell options because you don't have to worry about the tax consequences in the short term. Investment clubs are a great place to learn options with friends, partly because you can get to 100 shares easier with a few of you rather than maybe your own portfolio. I would say if you're going to do options and make that a primary learning thing of the investment club, that it should probably be a more active club, getting together more often than once a month. How often is going to be up to you, but I think once a month is not enough for really managing options. And I also did want to mention that bivio can handle options in their accounting. However, you do need the higher level subscription, what's referred to as the active partnership subscription. Quick recap. Remember, we need to invest in good quality growth stocks. Selling options is a great way to supplement your returns. Do watch the commissions. Make sure that they don't eat up your profits. be aware of the tax considerations. I highly encourage you to think about doing them in IRA accounts. And I think investment clubs are a great place to learn about options. One last thing. We've had problems when people have gone to their brokers to get approval to be able to do covered options. Most of them understand covered calls, and that's not a problem, but the minute you say you want to do cash secured puts, we've had situations where some of the brokers, Fidelity notably, kind of the first thing out of the gate, they say, well, then you'll need a margin account. That is not true. You do not need, and I don't think you want, a margin account to be able to do cash secured puts. So I encourage you to stick with it. Keep working with them until you get an account that can do both covered calls and cash secured puts without having a margin. I'm a little over time, but I want to thank you for attending. If you have questions, are there any other questions at this point, Lori?
Yeah, there are quite a few.
Okay.
A couple of people asked when you're talking about your APRs, are you including commissions in those calculations?
Yes, the APRs are net of commissions.
Okay, so your minimum 20% APR and 10% APR target numbers include commissions?
Yes, they do.
Okay. Chuck Burnell is asking, when you sell an option, do you put in a buy to close at 10% of your premium right away, or good to cancel?
I don't, Chuck, because I'm not buying it at 10% of what I sold it for. I'm looking for a 10% APR, and that number, that threshold, is going to change every day. It's going to go down with time. And so it's not a fixed number. It'll be higher today, tomorrow will be lower, the next day it'll be lower. And so I have to watch it and put buys in when it's close to that 10% APR level.
So somebody's also asking if when you calculate that percent return, is it based on the strike price?
The percent return is the same calculation. It is just the premium received. If it's a put, then you use the strike price because that is what you're exposing from an asset standpoint. If it's a call, I usually do it against the market price of the stock because that's the value of the asset that you're exposing.
Okay.
But it isn't going to make a big difference. You can use strike in both cases, and it's not going to change the APR significantly.
A couple of people are asking who determines the call or the put price or the premium.
It's a market just like stock prices. So you have buyers and sellers, and when you go to sell, you will be able to see where the bid and ask level is. So the bid is the best buyer, the ask is the best seller. You can sell wherever you want. You can put a limit price above the best seller, and you may or may not get filled. You may have to wait until the market moves up to your price. But it is a market. It's an open market, just like stock prices are, and it takes both a buyer and a seller to agree on a price.
Chris Hodgkin is asking if there's any good inexpensive programs that you know of to calculate all these things like the APRs, etc.
I do it via spreadsheets, and I've occasionally offered classes on a spreadsheet that I've put together on it, and keep watching on bivio, and maybe we'll do another class on that and offer it out.
Chris is also asking about with the new cost basis reporting requirements, are the brokers going to include the options price in the basis when options are exercised, or do we have to do that separately?
No. My experience for this past year was, and I've got 3 brokers that I use, and all of them did in fact include the um, exercised options, they included the premium in the sales price or included in the purchase price in the case of puts.
Do they include it in what they on the 1099, or
yes,
was it reported to the IRS?
Yes.
Okay.
Yes.
You have to report it regardless. The actual rule is that it has to be reported by them starting next year, but they had the option to start earlier if they wanted to.
Yeah.
So I think that's what they were doing.
Yeah, the thing that they are not required to report yet, but they did on is gains and losses that you made on your options outside of the ones that are exercised. So there's two different things. If they were exercised, they did in fact include those premiums in the either purchase basis or the sales basis of the stock. But gains and losses that you might have made on options by themselves did not have to be reported to the IRS by the brokers this year, but will have to be starting next year.
Somebody's asking if you have to report if the options trading is within your IRA.
No, you do not. Any gains or losses in the IRA do not have to be reported, just like normal. If you buy and sell stock in your IRA, that is not reported to the IRS.
There's a couple more kind of overall questions, but why don't we finish up and then we'll take these at the end.
Okay, great, because we are running a little over. So feel free to write questions to this email address, coolclub@bivio.com, and you say, well, that's kind of a different email address, and that brings me to my Steve Jobs moment where I'm going to say one more thing. We have started, or we're looking at starting something new called Cool Club, and what Cool Club stands for is Covered Options Online Learning Club. The purpose of this is going to be to learn the process around selecting covered calls by discussing actual recent trades. Our intent is that we will, each week on Wednesday, we will do a 30-minute discussion where we go through actual thought process and on actual trades that have happened in the week before. So this isn't going to be where we give you trades to do the next day, but it's an ability for you to understand thought processes, what went on what we chose, and how it performed each week. So just a place to learn. If you're interested in it, you can write us at cool_club@bivio.com. And don't we all want to be part of the Cool Club?
Yeah, and Paul is going to lead to moderate the discussion, and Paul's one cool dude. So if you want to be a cool dude too, or a cool lady, we suggest that you join us on Wednesdays. It's pretty interesting to actually talk through this. You really learn a lot when you actually try picking some options, and it really helps to have somebody that can help you talk through it. So I think you'll find a lot of interest. You'll find a lot interesting if you can attend. And yeah, it'll be the kind of thing you can attend at any time. Well, thank you very much. I think it was great.
I hope to see lots of you at the Cool Club meeting.
Yeah, because somebody's asking for somebody who's a beginner, no options trading experience, what would be a good starting point? I would really suggest you try coming to these meetings if you can make them, because listening to the thought process as somebody's talking through actually purchasing an option is really fascinating. And you know, you can begin to try and do your own thought process and do it on paper, and that is the best way to get started trying this. Because at some point you're not going to learn it until you actually try it, even if it's just on paper. But it helps. We're hoping that, you know, being able to go through, hear somebody talk through it that actually does it, I think you'll find that Paul gives you a lot of insight into what you should be thinking about when you're doing this. So I think you'll find it really interesting if you're able to make it. And we will be recording those, so if you can't make it at the specific time that he does it, they'll be available later. Thank you for coming tonight, We've enjoyed being here.
I appreciate everybody coming out, and I hope this gave you a nice little introduction to covered options. And as I said, I hope we see many of you at the Cool Club.